Hello, Sit Room executives. Welcome back to another episode. In this episode, we have invited Matt Moylan, a risk strategist that assists real estate investors in implementing creative insurance solutions to protect their assets. He provides us with insight into how insurance companies view the risk of a multifamily asset and offers some general guidelines to consider when selecting coverage. He also shares with us one of many ways he helps his clients not only reduce insurance costs, but produce additional passive revenue streams. All right. Well, Matt Moylan, welcome to the show. Thank you for joining us today.
Thanks for having me, Dion.
It is a pleasure. So why don't we go ahead and get started and tell our listeners a little bit about your background and how you ended up in your current position.
Yeah, absolutely. So I grew up in Omaha, Nebraska, and kind of found my way down to Kansas City after college. And I grew up in a household of educators. So that's a burning passion that runs through my blood. Went to school for education and found out soon thereafter that, I love educating and helping someone learn something new that they didn't know before, but the school system wasn't for me. So when I moved to Kansas City, I had a couple good friends that were in the insurance world and just kind of wanted to take a stab and see, if it works. If it works, it works. If it doesn't, it doesn't. And I can always figure something else out. So I started day one, and it was just right where I needed to be and where I fit, and kind of moving forward into how I got to my current position. It's definitely been trial by error. I worked on the captive side, so the couple big name carriers that everybody would know, and then I've worked on the insurance broker side as well, which is where I am now. So that's kind of how I got to where I am now.
All right. So can you tell us a little bit about your company?
Yeah. So like I said, based out of Kansas City, but our headquarters is in Boston. So I work for a company called Risk Strategist Company, or RSC. And we are not only in all 50 states, we're also internationally. So where that helps my clients is it doesn't really matter where or what the opportunity is. We can find and facilitate, a policy to fit what they're looking for. So we do personal lines insurance, commercial insurance, as well as construction bonds, employee benefits, and a handful of other insurance items.
And as far as what you're currently doing, or your particular client base, you're mostly working with real estate investors, right?
Correct. I kind of decided that the real estate niche the niche that I wanted to go into was real estate because I have a personal passion for it and a personal interest for it. So about 2.5 years ago, 3 years ago, I decided, hey, this is the route that I want my business to go down. And so, here I am that time later, and that's basically exclusively who I work with, unless it's kind of a one-off, hey, can you help me out with this? Or, hey, I have another business outside of real estate. Can you do this? Yes, absolutely.
Okay. So what is your view of risk when you're looking at multifamily assets?
So my view as a whole is that it's a great asset class to invest in from the investment standpoint. As far as the risk standpoint, it's a little bit more hairy. And, anyone who's investing in that multifamily space has probably seen or will continue to see a rise in rates. And, kind of basically it's kind of a squeeze on the market. So the market is doing what's called hardening. So what that means is basically carriers are adjusting their appetites. And so they are either getting out completely of writing multifamily, or they're adjusting their rates significantly because they've seen, massive losses, and just the risk is a little bit more higher of a risk than it was, classified 5, even 10 years ago. So that's kind of how I look at it. And that it's a great market to invest in, but from the insurance or the risk management side, it's definitely a little bit more challenging.
It's really funny you mentioned that. And I mean, since you did, I kind of want to get your thoughts and understand this aspect a little bit more myself. I saw a post. I think it was late last year, sometime in December, and it's from another multifamily investor that I know of, and we've talked a lot, and he's been on the show as well. And in his post that he put out there, he said, "Hey, look, guys, I just want to share with you an experience that I had because." A property that they had purchased not too long ago in Texas, when they got their new insurance quote for 2020, I mean, it was like 5 or 6 times higher than what it
Unbelievable.
was before. And I think, for them, that was kind of like, wait a minute, what is this? But luckily, they had enough reserves in their underwriting when they originally underwrote the property. So, I mean, really, what's going on? Like, why are the rates rising so high? And
Yeah. So
yeah.
there's, from what I've seen and from what I've read in industry articles, there's a couple main reasons. One is just due to the natural disasters that have happened over the last few years. So whether that be floods, earthquakes, fires, tornadoes have kind of been on the rise the last few years. So
Mhm.
that's definitely one. The other, I would say, more driving push to that is there's fewer carriers that are wanting to write habitational in general, even outside of multifamily. But then obviously that trickles to multifamily. So with fewer opportunities or fewer companies willing to write that business, the prices are going to go up. So, we've seen very consistently rates increase. I mean, if you have a good renewal, like
Mhm.
20%, if, we've
Wow.
seen 30, 40, 50%, if you have
Wow.
claims, it could very easily be 70% increase.
Wow, that's interesting. Because originally, when I saw his post, I was wondering whether or not that was more so specific to that marketplace, in Texas, especially given, the hurricanes and natural
Mm-hmm.
disasters that they had over the past few years, right? Uh, but I mean, hearing you, and you're in the north, I mean, and you're underwriting deals in the northern states and whatnot. And so you're saying that this is occurring in your area, in areas where you're basically underwriting insurance policies and things on as well.
Yeah, so like I said, we're licensed in all 50 states. So
Hmm.
where that helps me is if I have an investor from New York that's buying, a property in Alabama or in Texas, it
Yeah.
doesn't really matter. I can help them. So in that way, I have an advantage on other brokers that aren't licensed in all 50. And every single region has their own catastrophe, risk. So yeah, down south in Texas, especially the, very south, right? Yeah, you have your hurricanes and really along the whole eastern coastline, that's a legitimate threat. But then in the middle of the country, there's tornadoes and floods and fires everywhere. So it's, I think that just domestically, it's been kind of a common trend by carriers to either completely pull out of the market or just really restructure and think of, hey, where are we writing our business? And they're becoming very, very particular in what they want.
I'm very curious to know, with the investors that you have worked with, so far, have you had I'm sure you've had these conversations with them. I mean, have any of them ever mentioned to you how they are dealing with this type of a situation? Because I would imagine, especially for some investors, uh, in that maybe they purchased a property last year, or 2017 or 18, this wouldn't have shown up in their underwriting more than likely,
Yeah.
and I mean, for their insurance costs to go up by that much in 2020, and then going forward, I mean, how is that going to impact their returns? I mean, have any of the investors had these conversations with you?
So because it's so early in the year, I mean, these
Hmm.
rate structures really kind of started like November-ish.
Hmm.
They've been trending the last 18 months, right? So really anytime in the last 18 months, it's kind of been a recurring, trend, or you've been able to see if you've bought multiple properties over that time frame, or even just two, or underwritten, right? Not even bought them, that things are changing. Things are happening in the insurance world. So can you forecast that? No. But can you do things to potentially forecast it? Absolutely. Talk with your broker, or, I don't necessarily recommend getting multiple brokerage quotes, because then you're just kind of minimizing the opportunities for your main broker to look at quotes. But, and that kind of trickles down to find a broker who is licensed in all 50 states, who does focus in and have multiple markets for multifamily, or just habitational in general. Because those brokers who do have those carrier relationships are going to have the best available opportunities for writing the business.
Yeah. I'm very curious to see how all of this plays out, especially because I'm sure cap rates are compressed, and people are just paying way too much, I think, for a lot of the inventory that is available out there. And for those that were not conservative or not enough in their underwriting, especially when it comes to this issue, and they hadn't even anticipated this. I mean, they ended up overpaying for that property, and suddenly, everything was, margins and everything were already thin enough, right?
Right.
And then how is this going to impact their investment returns? I'm very curious to know, what size of the market would be faced with this type of scenario.
Yeah. And that's a great question. And I wish I had a good answer for you. One thing that I help with my clients get to, and I know we'll talk about it later, but I don't necessarily say, or look at, let's say, Dion, you come to me and say, Matt, I have this property, it's 200 units, and I want an insurance quote for it. Okay, great. Absolutely. I can definitely help you. I'd love to help you, but let's look at the whole situation, right? Do you have other properties? Can we put them all on one policy to, get a not a discount, but a better per unit rating?
Okay.
Are there passive income opportunities that we're missing out on? And is there something that I can help with? So there's different measures to which I kind of take my investors through that, and my investors that I work with, and also that, that I have clients, to let's reevaluate. And especially in 2020, 2021, when they continue to increase, how can we minimize that increase, but not by cutting coverage?
Yeah. Yeah. So speaking of, let's kind of talk about that assessment process that you typically, take your clients through. So, what is that assessment process like, the risk assessment process, and how do you help them mitigate risks and protect their assets?
Yeah, absolutely. So the process I go through, it's a comprehensive process that it kind of varies two different ways. So if you're doing a new purchase, then, hey, let's look at that individual property right now, and let's get that to you so that you can get a good idea on your numbers, right? Going back to what we just talked about, of insurance can be a massive player, even if you already have those estimates completed. So the sooner you can get a new quote on a new property, the better. And I realize that as the risk management side. But in that initial conversation, we'll also go over, what other opportunities are you working on? What other, assets do you have in your portfolio? Is there any way that we can consolidate all of those onto one policy, or what's called a master policy? Because I compare it to like manufacturing, right? So if you were to go to a manufacturer and say, I want 100 hats, and you go to that same manufacturer and you say, I want 1,000 hats, your price point is going to be different on each one of those. And you're going to get a better price point on that 1,000. So your master policy in insurance is going to be the exact same way. The more units, the more doors you have on one policy, the better per door rate you're going to get. So I kind of go over that as a complete option for the new purchase. We also go over what are some passive income opportunities that we could implement. Are there energy efficient ways that we can, implement into the property that don't necessarily have anything to do with me, but I look at your bottom line because I get that side of the business.
Mm-hmm.
So that's for a new purchase. For the renewal side, it's a little bit more cut and dry from my standpoint. I know that we're still going to have that introductory comprehensive phone call, but it's going to be more of let's say you have 5 properties. We're not going to look at 5 policies. And if you don't, if you want to look at 5 policies, I'm probably not the guy for you. But what I can do is let's consolidate your portfolio. Let's put it all onto one policy. Let's get that, bundle discount, if you will, or that manufacturing per unit discount that is going to open up more companies and more opportunities for us to write business.
So do you find that it's easier to get the insurance policy if you bundle it rather than just doing it for one particular property right now in the multifamily space? Because remember, we were talking about the issue earlier, right, where you said some of the insurers don't even want to insure a multifamily really anymore, right? So do you find
absolutely.
Mm-hmm.
Yeah, no, and that's a great question. So that's kind of two-faced, right? So there are carriers that can and will write that one-off property, but there are carriers that have minimums, and they won't even consider, minimums as far as door goes, or what's called the TIV, or total insured value. Okay, so they have that minimum TIV, and so unless you hit that point, you're not even qualified. So you have that one property, you can qualify for some, but not all. You put all your properties onto one, obviously your total insured value of your portfolio is going to be higher than that one, and you're going to get a better potential quote unquote discount, or your better potential price per door.
Mm. So at minimum, typically, what kind of coverage do you think is necessary for, these types of investments? Because typically a lot of the multifamily syndicators out there are usually at least 100 plus doors, right?
Right.
So what do you typically suggest on coverage?
So at an absolute bare minimum, and it's going to seem kind of obvious, but an absolute bare minimum is going to be property coverage for, the physical structure, right? Your general liability. So someone slips and falls, someone gets hurt on your property, and then an excess policy or an umbrella policy. So those 3 things are kind of they're 3 individual policies that make one package. That's the absolute bare minimum I would recommend for any investor. And obviously there's more, but that's the bare minimum I always at least suggest to my clients.
Okay. And then typically, what do you find kind of added on top of those and that you find to be kind of suitable? Just a couple other items that you found that are quite suitable for these up and above the bare minimum.
Absolutely. So one that definitely comes to mind is coverage for like water backup or water damage to the properties, because that is not automatically covered under really any policy, on a personal or commercial policy.
Would that, I don't mean to cut you off, would that cover like the main pipeline going into the property as well, like these types of issues?
So typically no.
Okay.
Some carriers it adjusts a little bit, but so the water backup, sewer backup, some pump overflow type coverage.
Okay.
That is typically going to be from, best way to think of it is from the shell of your house, or from the shell of the complex property structure in. Okay. And then from that exterior point to the street or to the parking lot, that's going to be what's called like your service lines. And so that is normally a different coverage, but some carriers, they'll include that in, but that's few and far between.
Okay. Okay. Got it. Because that reminded you, when you mentioned that, it just reminded me of another investor. We had a conversation, and on several of his deals, he ran into this situation where, they hadn't quite inspected for it, and it just came. It was something that came up, and it was quite a costly repair. Replacing that main pipe there.
It is,
Yeah.
and a lot of investors just assume, oh, my insurance has got it, it's covered, and unless they've specifically asked for it, or their broker did the correct due diligence in offering it, they're typically multiple $1,000, even tens of thousands of dollars for a single, break in a line or frozen pipe or one loss.
Yeah. Yeah. So, what is your thought on renter's insurance? Because I've heard a lot of mixed things with regards to this in the past.
Yeah. So there's two ways that I go about it. The first one is that absolutely 100%. I don't care if you have one single family house that you rent out or you have 100,000 units, anywhere in between. Renter's insurance is a must, because the best way to think about it is it takes that expense and it transfers it away from your balance sheet to someone else's balance sheet. And the more that you can transfer off of your balance sheet, the better off you're going to be in the end. So 100% I recommend it. For investors who have over 150 units, I typically at least bring up with my clients and heavily suggest that they look into, it's called a master. It's technically not renter's insurance, but it's a master insurance program that basically all of their units can go on. And so that mitigates the need for individual renter's insurance. It provides, some basic peril coverage and some liability to the property as well. So I'm actually doing a webinar on that on March 17th.
Oh, nice.
At 10 a.m. Eastern time. So anybody that listens to this, if it comes out in time, is more than welcome to jump on.
Yeah, and if you could send me a link to that as well, or the invite page or something, so I could include that in here.
Absolutely.
So that way I can get that out. That'll be really good information. So would this fall under some of the different passive income opportunities that you had mentioned earlier? So if the investor is buying into this, what was it called, a master insurance?
So it's kind of like a renter's liability type policy, but it provides both the liability and contents to it. So technically it's like a renter's policy, but it's not like if you and I were to go get renter's insurance.
Okay. So if an investor were to buy into this policy per se, and correct me if I'm wrong, it still covers the individual units, like the contents of the individual units and the renter. Now, does the investor in turn sell this per se to the renter?
Great question. So they don't sell it.
Okay.
So they don't have to have an insurance license. They don't have to do any of that. Simply, it gets integrated with your property management software, and it collaborates with pretty much any big name one out there. And essentially, when you sign a new tenant up, or tenants renewing, you can have in the policy framework that this is going to essentially be in effect, and how it works. So I'll give you an example. I have a client who has roughly 1,000 doors, and we brought this on about middle of last year. And they, the program is essentially paid by the tenants, and then, by their, tenants, and then they just add a certain dollar amount onto the, on top of rent. So let's say they charge $15 extra a month. So this passive income part that I talk about, for their unit, for their 1,000 units, they would make roughly about $72,000 in their program, how they have set it up at this point. Now, if they change it, I don't know, but those are the number figures that we were looking at. So obviously it's definitely going to help their bottom line. It's going to help their profitability. It's going to minimize, claims on their big master policy moving forward, because you can make a claim on the smaller policy. And you can guarantee that your tenants are actually covered, as opposed to them going to their local guy down the street, getting a renter's policy and canceling it 2 months later. Well, then that liability is put back on you because it's your property. So having a program like that not only helps you gain additional income for the property and your portfolio, but it gives you more of a peace of mind that everybody is covered, period.
So what, so in this example, you said that, let's say it's about $72,000 a year, right? So what would be my incremental cost for, basically buying into this policy under this master policy?
So it depends on the type of unit size that you have, but for this specific example, they were all, medium to large size apartment complexes. And so with their portfolio, it costed them a little over $8 per door per month.
Okay. So 50% margin then.
Right. So then they would charge what they charged was like $15. So the difference in that, above the, whatever it was, 850 or whatever that number was to 15, that's the quote unquote, passive income opportunity that they're receiving per door per month.
Okay. All right. So it's, I guess it's the subject of passive income opportunities. I mean, this sounds like it could be a really great way to even, essentially lower the insurance costs, because, I mean, you figure, you're paying $8 more per unit per month, but you're getting something up and above that, right? And that can be theoretically applied to the other aspect of the policy to kind of lower that cost. Because we have been talking about how costs are increasing, right? Insurance costs. So what other passive opportunities have you seen in your experience working with your investors?
Yeah. So the other one that I've kind of found that, lowers that overall, it increases the economic value of the property, but lowers the, the efficiency cost, if you will, or the energy costs. So another guy here in Kansas City, he and a partner are kind of starting up or running like a solar company. So they are, I haven't yet had anybody directly work with them, but it's something I'm bringing up to a lot of my clients, saying, hey, if you're looking for other additional, economic value add opportunities to your property, consider this. And, then they kind of work and see if the numbers, make sense, right? Because if it doesn't make sense, don't do it. But that's kind of the other value add part that I bring to a lot of my clients. And kind of the other thing that I talk to my clients about, that's not necessarily going to create passive income, but it's deductible buy down programs. And I actually just did a LinkedIn series breaking this down. But basically my investors I'll suggest, hey, let's look at increasing your deductible from, 25,000 to 100,000, 500,000, a million, and implement a specific program that would be an additional policy, right? But it would lower your deductible by this second policy. Okay. So for example, like $10,000 on this separate policy, and your main insurance policy would be, to make it easy, let's say $100,000. So that second policy, that deductible buy down, would cover the additional $75,000 of that gap. So it's kind of essentially an additional layer of protection that it lowers your overall cost of your policy, right? But it doesn't cost you any coverage. And the out-of-pocket expense is also minimized.
So, okay, so I just want to make sure I got this. So you said in this example, the first policy has $100,000 deductible, right? So then
Correct.
you buy a second policy with a lower deductible of $10,000. So in the event there's an insurable, there's an insurable event, right? So then walk me through that process, because I think
Yeah,
you sort of lost me there. So if there's an insurable
absolutely.
event, what would happen?
So that second policy is what's called
Mm-hmm.
a deductible buy down program.
Mm-hmm.
Okay. So you would get coverage for that full $100,000 on your regular policy deductible.
For
Okay.
10,000.
Right. And you would pay 10,000.
Okay, got
Does
it.
that make sense?
Yeah,
So
yeah, yeah.
you would pay
Okay.
10,000, and then that deductible buy down would essentially, think of it, they would add coverage from 10,000 to your $100,000 deductible on your main policy.
Okay.
Right? So you pay out of pocket $10,000, and that covers basically all of your insurance expenses.
Okay. Okay.
Did
Okay.
I make
Wow.
that clear enough?
Yeah, yeah, that's very clear. Yeah, that's actually the first I've heard of this, to be honest. And you said you did a few LinkedIn articles or videos on that?
Yeah, so I did a
Okay.
5-part series that actually ended on, I think, Monday or Tuesday of this week, basically breaking that down and explaining part by part, who can use it, how it can be used, different deductible buy down programs. So yeah, it's a series that I just kind of created because I found that the educational side of me, right, that
Mm-hmm.
there was a huge knowledge gap. And with these rising costs, it's a way to, even if we can keep the policy premium exactly the same, but if we can lower the out of pocket expense for you, that's a win. That's a massive win.
Yeah.
If we can save money and lower the out of pocket cost, I mean, that's a double win, right? So that's kind of the mind frame that I take with my clients, and looking at, we go back to the beginning of, can we look at a single property? Yeah, absolutely. But as we grow, and if we have multiple locations and multiple complexes to insure, let's put all that on one, because there's a lot more of creative insurance solutions that we can find and we can essentially make for your portfolio, asset profile.
So what have you seen, or out there that you would consider to be one of your biggest challenges or case that you've come across so far that you had to
Yeah,
cover in this space?
absolutely. Absolutely. So I was working with an investor from the New England area of the country, and they had 5 properties in 2 different states. And between those 5 properties, they had 3 insurance brokers. So they were spread out. The coverage, as you can imagine, was all over the place, very inconsistent, because my client didn't know what to ask. He just said, "Hey, I need this property insured. Give me a quote." So everybody does, brokers do different jobs. They have different recommendations. So kind of what I walked him through was exactly that. He was going through kind of a new purchase and saying, "Hey, I need a property quote." And I said, "Great, I'd love to help you. What else do you have?" And so he kind of outlined it for me. And sort of like I outlined in the beginning, I gave him that initial quote. And I said, "If we can look at these others, here's the potential opportunity at rate figures that we could be getting." And it was saving him, I can't remember the exact figures, but it was a significant savings per door, because he went from one single property of, a few million dollar purchase price to now, 30 million in a total insurable value. Well, there were a number of carriers that were like, "Oh yeah, absolutely, we'd love to write it. Here's some figures, and here's what we can do, and here's some options where we can be flexible." So it definitely opened up the door to not only consolidate his portfolio with one agent, but mitigate the cross policy coverage differences, and gave him more peace of mind We also implemented that, that passive income renters program that created an additional, I think like $35,000 for him, which he wasn't getting before. So that, I mean, it started with a single challenge of, yeah, we can absolutely do that, but have you ever looked into this? No, you haven't. Why? Have you ever been presented it? And no one had ever walked him through what his options were, which is kind of where my strength came into play.
So one other question I have for you that just kind of came to mind. What do you think is like one of the biggest mistakes that you find investors are making? Like you said, this guy, he had like 3 different insurance brokers and all the policies were different. And what do you find are like some of the biggest mistakes these guys are making?
Yeah. So I would say the biggest one that I see most consistently is they take the personal insurance mindset of shop, right? Get numerous quotes from numerous companies or brokers and compare. In the commercial side of insurance, whether you're dealing with multifamily, commercial, retail, business insurance, the commercial insurance world is a world where if there's 3 different insurance brokers working on the same quote, whoever gets the quote in first, they block everybody else out. So that means that the other 2 brokers cannot access that company that was originally quoted. So their best offer is going to be potentially the second best company, right? So, and then the third guy is going to have the third best. Now, insurance brokers have different company opportunities or companies that they do business with, but a lot of brokers use the same wholesale brokerage type companies, which, to make that very simple, it's a brokerage that your broker has a contract with. Okay. So in their world, it's first come, first serve. And if you're second to the party, you get served second and you get the second best opportunity. So a lot of insurance brokers have those similar wholesale relationship with insurance brokers. And so that, I would say that's the biggest thing that I see. I hope I didn't go in too many circles, but it's a difficult concept to put out there because it's not something that is really ever talked about or explained. But again, simply put, work with one broker, create that relationship, trust them. And if you want to try and minimize your costs, look at increasing deductibles, look at other programs, and look at, deductible buy down programs and passive income programs.
All right. Yeah, I actually hadn't realized that in the commercial space, let's say that if we are working with you and then, like you said, you got a quote from, XYZ carrier, if we went to someone else and they wanted to get a quote from XYZ carrier, basically they would be blocked out of that because, in the eyes of that carrier, I am your, customer and essentially, right? I had no idea that it was like that in the commercial space.
Yeah. And that's why I say, it is the number one thing I come across, because everybody wants the best price or the best policy. But at the end of the day, if you're shopping numerous insurance brokers, you're probably not getting the best due diligence from your broker side because they literally cannot provide that to you.
Mm-hmm. All right. So what would you say would be a key piece of advice you might have for our listeners out there?
I would say that relationships are key. And, on the insurance side, find a broker that, one, specializes in doing real estate in general. And if you can find a broker that specializes specifically in doing multifamily, that's even better. A lot of insurance brokers, they say, they have the ability to do anything and everything. So simply put, find that relationship, do your due diligence, and as you grow your portfolio, try and get to that niched real estate, multifamily insurance broker who not only knows what they're doing, but has the products available to suit your needs.
So do you have any favorite books?
I do. So I would say my favorite book that I read probably, well, at least once a quarter, it's called Never Split the Difference by Chris Voss, which is, it's a common one, but I love it. There's so many great life and, professional concepts in it. The One Thing by Gary Keller and Jay Pappson, I believe. I actually just finished that one and really enjoyed it. And then there's one other one. I can't remember the exact name of it, but it's like 92 ways to communicate, 92 ways to talk with anyone, but it's by Lyle Lowndes. And it's a bunch of, life tips on how to communicate with others and, just vibe with them, create relationships, whether you met them for the first time or it's been a long time friend and you just kind of want to further your relationship.
All right. Yeah. I think a lot of people, once they really get involved in real estate, I would just say real estate in general, even if you're in just a real estate agent, you're working in residential, but even, in the commercial space, it is a lot of relationship building. And actually that's how we met.
Yeah,
we met,
absolutely.
we met via LinkedIn through communicating back and forth on different posts on LinkedIn. So,
yeah,
it is really, really important. So how could our listeners get in touch with you if they wanted to reach out?
Yeah, absolutely. So I just here recently launched my blog. It's called Mitigation Minute. So I'll send you the link and we can link that up. And then the other way is feel free to reach out to me through that platform, and we can set up, insurance reviews or just kind of talk through your situation. Like I said from the very beginning, my biggest passion in what I do is educating, and so that's why I started this blog and this platform, is to further educate and just provide resources to the people that I find that need them. So whether that's multifamily investors, large or small, or other capacities in real estate, commercial, whatever. So yeah, definitely my blog, Mitigation Minute. I also have a hashtag on LinkedIn, just hashtag Mitigation Minute. So I would say that's probably the best way that you can reach out to me.
All right. Well, thank you so much, Matt. It's been a pleasure having you on here today. I really appreciate you joining us.
Thanks, Dion. Appreciate it.